What is pre-money valuation and post-money valuation calculations, and why are they relevant? Well, pre-money valuation is simply the value of a firm prior to raising equity or prior to an investment transaction occurring. Post-money is the value of the firm after that transaction. The pre-money valuation is simply the valuation arrived at between the company and the investor by whatever means or method, whether that's industry comparables or for a mature company, discounted cash flow, or some other method there. And after the investor puts in capital, that's initial pre-investment or pre-money valuation plus the amount of investment is the post-money valuation. Now, determining the number of shares that the investor receives in exchange for the money is relatively straightforward. You simply say, what is the fully diluted capitalization? That is the total number of outstanding common shares, and any options or preferred shares or warrants that would convert into common shares. Add all those together and divide the valuation by that number, and that would give you the price per share, and that's the price that the investor would pay per share. So whatever the investor is investing, divide that by the price per share, and that's the number of shares that the investor receives. Now, an investor is probably going to receive a preferred share. So if that preferred share has some conversion characteristics that converts the preferred share into more than one share of common stock, then you would adjust accordingly as to the number of preferred shares so that the common stock equivalent or conversion ratio would make certain that the investor receives the right amount of shares at that valuation. So pre and post money valuations really are just used to understand the value per share that the investor is paying, so that once again you can understand the number of shares to be issued as part of the transaction.